Just crack open a beer if you're sad. They're only numbers. They can't hurt you. Make the bad numbers go away. Hey everybody, Walrus here from Walrus Street, bringing you your news and earnings for the week of October 18th, 2021. Just a reminder, I am not a financial professional. All information in this video is for entertainment purposes only. You might be looking at me and wondering why I'm dressed this way. Usually I do the collared shirt, other than my deviation last week. Well, it's bloody cold in my apartment. You guys remember I just moved into this apartment in August, and I had to turn on my heater for the first time this weekend. On Friday, we were sitting at a nice, comfortable 22 degrees Celsius, and it is 0 degrees Celsius outside, freezing, 32 in Freedom units. And I went to turn on my heater, and it just doesn't work. So I called the repairman. Repairman can't come, and now I'm just living inside an icebox. So here I am, filming from my icebox. I have some super exciting news. I'm going to be starting a new series on my channel, a new weekly series, and it's going to be focused solely on options trading, specifically running the theta wheel, and I'm going to be going through all of the options tutorials, everything associated with that. I'm going to be releasing a series of very short videos this week leading up to the inaugural episode of my new series, which is going to be debuting next Friday. I do hope you guys enjoy that in advance. I'm super excited to be putting it together. I have a script. I've been working on scripts for each episode, and I never actually do scripts for my videos, so this is totally new to me. But I've been doing pages and pages of notes on my thoughts and stuff that I wanted to say, and it just goes on and on and on, and it's beautiful, and it's color-coded. And it's content. I hope you guys enjoy it in advance. Please check it out. Even if you don't really like options trading, I still will be talking about some stock analysis, company analysis in that series. And once again, it's going to be a weekly series. Short videos leading up to it explaining the strategy this week. First video is going to be debuting on Friday. The market was pretty positive overall this week. We got back some of the losses towards the end of the week that we had incurred the weeks before. I don't want to say the recession is canceled, but it definitely felt pretty good to see a lot of my positions in the green. Microsoft had a really big jump up during the week, and you guys know that's one of my largest holdings, so I was very happy about that. Enough chatter, let's get started with the news. I thought I would start with a moment of levity here. This was a Reddit post. This isn't really news, but this is the average and median net worth by age according to the Federal Reserve. So here you go. I'm not going to read them all off. You could see it. The median net worth and the average net worth are very, very far removed. 35 to 39, median net worth $55,519. I saw this. I was feeling pretty good about myself, and then I went ahead and clicked on the next tab, and I looked at the average net worth of somebody who's 35 to 39, $274,112, and I was like, damn. That's a little depressing. Man, there is a huge positive skew here between the median net worths and the average net worths. Look at this. Somebody 18 to 24. This is a college-age individual. Median about $8,200. Average net worth is going to be about $28,700. I mean, that is a really huge positive skew. So typically in data, when we have a positive skew where the average is so far above the median, there are outliers that are leading to the average to be much higher, and you can already imagine what those outliers are. That would be the 1%, the millionaires, the billionaires, and they're pulling the average up very, very high. It's just leading to that skew where it just seems disproportionately unrelated to each other. I mean, we've got a $200,000+ difference in the average for my age group compared to the median, so yeah, it's a pretty big skew. Anyway, just thought I would share that with you guys so you could pause the video and see where you fall on the scale according to the data released by the Federal Reserve. Don't cry about it, just crack open a beer if you're sad. They're only numbers. They can't hurt you. Make the bad numbers go away. First real news story, Deere and company workers go on strike after rejecting their contract. More than 10,000 Deere and company workers have walked out on strike after the United Auto Workers Union said negotiators could not deliver a new agreement that would meet the demands and needs of the workers. The vast majority of the union rejected a contract offer earlier this week that would have delivered 5% raises to some workers and 6% raises to others at the Illinois company known for its green tractors. So that was the the company's counteroffer to whatever the union was demanding. The counteroffer seems okay, 5%, 6%, but you kind of have to remember that wages have not kept pace with inflation for like the last 2+ decades, and average inflation was about 2% per year up until this year where it's like 5+%. So offering these workers a counteroffer with only 5 to 6%, I mean, I don't know what Deere's salary schedule was, but I'm assuming they're like every other corporation, and their salaries also were not keeping pace with inflation, so these workers are probably severely underpaid. Going on strike is the classic strategy of you pay me. I'm not exactly a big fan of unions, but I am a big fan of being a decent freaking human being and paying people what they deserve and what they're worth. I hope that the workers do get almost everything that they want out of this, and really this strike could not have come at a better time. We've been seeing it with news stories almost every single week on this channel where there's a labor shortage in America. There's a labor shortage in America, and all of the federal assistance from COVID is either done or coming to an end, and the state assistance is either done or coming to an end, and there's still a labor shortage. And this disconnect makes me really think that people are just fed up with low wages and they're demanding higher wages. And we've seen this from companies like Target, McDonald's, Amazon, where they're lifting their minimum wages above the federal minimum wage, where they're offering signing bonuses for workers, where they're offering different types of perks for signing on. You know, Target was doing weekend pay leading up to the holidays, like higher weekend pay. I mean, these companies are trying all sorts of tricks, and it's going to end up resulting in higher pay. I'm going to say this right now. If you look at the graph of the average wage in America, when we reflect on 2021, 2022, we're going to look at these 2 years and we're going to see the average highest increase of wages in a long time in this country, because companies simply need workers and workers are refusing to work at the current wages. So, like I said, I'm not a big union guy, but I am a decent human being and I want these people to get paid what they deserve. I really just want wages to keep pace with inflation. Is that so much to ask? Take a look at Deere's chart. I don't really want to go into this very much, but they hit oversold on the day that the strike happened. The day before the strike, the stock closed at 329, and the next day it opened up at 321.53, which is it's a pretty substantial drop. But the next day they ended up finishing even higher. So it's almost like, according to the shareholders, the stock price really wasn't even affected. So I'm not really sure what the thinking here is. I would think that if a strike happens in a company, that the share price is going to tank, because even a single day of no productivity for these companies is going to be affecting the bottom line. And also, we're in a period of supply chain bottlenecks. So I don't see how, when you're already struggling with supply chain bottlenecks, to lose even a single day of labor participation, that this doesn't have a negative effect on the company. I expect the stock price to come back down, but the volume is only barely above the low point. So it's not like a lot of people are betting on this. And I'm not going to buy puts on it, but I really do expect in my head the stock price to go down. And it looks like we have a bit of a support here at 320. We've hit that a couple of times. So maybe drop back down about towards 320. Next up, we, every week we see Jerome Powell saying stuff like inflation is transitory. Inflation is transitory. Okay, inflation's going to last a little while. Well, the Atlanta Fed President Bostic said transitory is a dirty word as inflation lasts. Oh, it's so dirty. The Federal Reserve Bank of Atlanta President Raphael Bostic said this year's inflation surge is lasting longer than policymakers expected. No shit. So it's not appropriate to refer to such price increases as being transitory. He said it's a dirty word, and he spoke with a glass jar labeled transitory at his side, depositing $1 each time he used the swear word, as it's become known to him and his staff over the past few months. I applaud President Bostic for doing what we all already knew, that inflation was not transitory. You can't have PPI numbers coming in as high as they are, leading to higher CPI numbers, and expecting this to just be transitory. You can't have supply chain bottlenecks that are affecting every freaking industry and expect it to only be transitory. It's here, it's gonna stay for quite a bit. Bostic, who votes on monetary policy this year, endorsed the federal open market market committee's plans to taper its $120 billion in monthly asset purchases, which is likely to start at its November meeting. Bostic did say the U.S. growth and the recovery in employment have exceeded his expectations. I mean, this guy's expectations must have been terrible because the employment recovery kind of sucks. And he also said tapering is unlikely to slow the economy because markets are functioning well and the issues with the U.S. economy are more about supply chain disruptions from COVID rather than demand. And we have seen this. You know, we've seen every single earnings report coming out of these companies talking about supply chain disruptions, talking about supply chain cost increases that they then have to pass on to the consumer. And we understand this. And you don't even have to look at this issue from the top down. You don't have to wait for the federal government to say there's supply chain issues. Just look at every single earnings report. Read the transcripts of every single company's earnings report. Their CEO is going to say something about supply chain disruptions. Every single company. It's ubiquitous right now. So hearing Bostic like finally acknowledge this feels so good. It feels so free when the upper echelons of the largest bank in America are finally acknowledging what we all hold to be true and we all recognize as fact. So I feel like finally they're not lying to us anymore and we can move on with life. We understand inflation is here, so how do we combat it? So we're going to be looking at tapering, we're going to be looking at the rate hikes. If he's saying the economy is progressing and the jobs market is looking better, I guess that's something that the Fed overall is looking at. I don't know. I still think it's going to be a couple of months before we see any big changes, probably after the retail season, because nobody wants to crash the markets going into the black season, which is going to be the season when all the retailers are finally turning a profit. You want to keep that momentum going through the holidays, and then maybe in the doldrums of January, February, we start seeing some rate hikes. Who knows? They've been talking about like the beginning of 2023. We'll see. Just a quick note, the US September PPI is at 8.6% year on year, and it's versus the 8.7% expected. The prior month was 8.3% year on year. The big surges are coming in food and energy. Just a reminder, guys, the PPI is the producer price index, and the producer price index is less commonly reported on than the consumer price index because people care about what's most immediately impacting them, and the consumer price index is more immediately affecting the American consumers in a consumer-driven economy. But the producer price index is where all the magic is happening because this is where you could see the true costs that these companies are incurring. And a lot of the companies are being forced to use their cash reserves to help curb the cost that's being passed on to consumers. If you look at these numbers here, the PPI is sitting at about 8.6%. What about the CPI? The consumer price index rose another 0.4% in September, pushing the year-over-year gain to 5.4%. 5.4%, 8.6%. I know math is hard, but that's a 3.2% difference. And I realize this isn't something that can be directly compared, but inflation is inflation across all aspects of the supply chain. If the producers are paying 3% higher for their products and the consumers are only experiencing 3% less inflation for their products, that difference has to come out somewhere. That means the producers are probably eating into their cash reserves right now, which means this inflation is going to last because they're going to have to keep these inflated prices going for a longer period of time to build back up their cash reserves to get to that position where they actually feel safe and secure financially as a company. So right here, just this disparity in the 8.6% in the PPI and the 5.4% in the CPI, that disparity right there, that little bridge, it shows you that this inflation issue is going to be lasting for longer than anybody's willing to admit. Next news story, Evergrande's $1.7 billion Hong Kong headquarters sale flops as buyer withdraws. Chinese state-owned, I'm not even going to try to pronounce this, property company has pulled out of a proposed $1.7 billion deal to buy China Evergrande Group's Hong Kong headquarters building over worries about the developer's dire financial situation. The collapse of the talks for the landmark building's sale is another setback for cash-strapped Evergrande, which has been scrambling to divest some of its assets to repay creditors knocking at its doors. With more than $300 billion in liabilities, it has already missed 3 rounds of interest payments on its international bonds. So this was touted like some huge story this week, and I actually don't think it was that big of a deal. They missed out on selling their headquarters for $1.7 billion, but you have to remember that they have like $300 billion that they owe, so this was like 1/150th of what they actually owe that could have been paid off with the sale. But what I thought was interesting is that this was a Chinese state-owned property group that backed out of the deal. This makes me feel even stronger that China wants Evergrande to go under at this point to use it as a model. So they probably fed information to this state-owned property group and they just said, wait, because honestly, why would you pay 1.7 billion now when you can just get the same building at auction in a couple of months for pennies on the dollar or fractions of a yuan? What are the equivalent of pennies in the Chinese currency? I have no idea. Or is it Hong Kong dollar because it's in Hong Kong being sold? I don't know. Either way, you can get it for a fraction of the price months from now when it goes on auction for the lenders to get their money back. The fact that this was a Chinese state-owned company that backed out of the bidding really makes me feel very strongly that Evergrande is just going to default on everything and go bankrupt, and the whole situation is boned. In much the same light, Evergrande misses its third round of bond coupon payments, intensifying contagion fears. Some bondholders said they did not receive coupon payments totaling $148 million US on Evergrande's April 22, 2023, 2024 notes due by 4:00 a.m. on Tuesday, following two other payments it missed in September. This puts investors at risk of large losses at the end of the 30-day grace periods as the developer wrestles with more than $300 billion in liabilities. I mentioned something last week and I was actually very wrong about it and I totally forgot. I was looking at the bank earnings reports wondering what was going to be said about China, but none of the banks really said much about the China situation, and that's because we're still in that 30-day grace period for Evergrande to pay back what they owe to make these bond payments to the banks. So there's not going to be anything said in these 30 days, but these 30 days are soon going to be elapsing here. Maybe this week it starts for the grace period, I think. So we should be seeing a really big news cycle kicking up towards the end of this week, early next week, about the effect of these Evergrande payments missing, about Evergrande defaulting and going past the 30-day grace period. So that was an error on my part last week. I thought they were going to say something on the earnings report. I forgot that we're in the grace period. I knew about the grace period. I just, sometimes the information in my head, it just gets all messed up and I just forget everything. Anyway, 30 days. We'll see it soon. I've never talked about Porsche on this channel, but Porsche's Taycan, the company's first fully electric model, outsells the flagship 911 sports car. Porsche reported deliveries for the first 3 quarters of 2021 on Friday. The sports car maker's fully electric Taycan outsold its flagship 911 gas-burning sports car in the first 9 months of the year. According to Alex Partners research, electric vehicles now comprise about 2% of all vehicle sales worldwide, and that share is expected to rise to about 24% of worldwide vehicle sales by 2030. In a sign that drivers are embracing battery electric models, sales of the Taycan surpassed those of the company's influential high-performance 911 series. Deliveries of the Taycan hit 28,600 and deliveries of the 911 hit 27,900 during the same period. The Taycan, a 4-door dual-motor sports car, was seen as a high-priced competitor to Tesla's newer Model S sedans at the time of its debut. Now, I thought this was really cool because this is further evidence of the shift towards EVs, but also it's grounded in a bit of reality that only 2% of the new cars sold this year were EVs. So, that's just 2% of the new cars, which means there's still used cars on the road. EVs are still just an infinitesimally small fraction of the overall worldwide vehicle fleets. So, keep yourself grounded before you go out and invest in Workhorse or Go EV or Lucid or whatever. It's still something that's on the rise. It's a new trend, and a lot of these companies are factually overvalued, and they're leaning so far into future value that it's just not realistic. I did find it very surprising, though, that the Taycan did overtake the 911. Part of that is because the 911 is a legacy car. It's been around for something like 50 plus years, and it's just got that clout. There's something special about owning a 911. So this was interesting to me, to say the least. And we've seen the same trend. We've seen Tesla releasing their vehicle figures last week, and they were blowing out expectations. We know that Ford's Mustang E-Series has been selling much better than expected, and we also know that Ford has taken an incredible amount of pre-orders on its F-150 electric vehicle truck. So there's just a lot of excitement around this industry, and I just wish there was a value opportunity, because nothing is a value right now. Everything is going public via SPAC, which is going to take valuations based on like 5 years of future earnings, and there's really nothing that looks like a great value except for some of these legacy automakers like Ford Ford and GM. Yeah, that's kind of it. A little more about Tesla. Speaking of EVs, Jeffries raised its Tesla price targets to $950 a share over strong demand and growing capacity. Jeffries cited several reasons behind its update, though the analyst noted that part of it is due to the growing gap between Tesla and the legacy OEMs. And this is kind of crazy. They're saying that Tesla is going to be outperforming the legacy automakers. The Jeffries analyst noted that demand has so far been stable for Tesla. The company's production capacity is getting better too. With strong demand and ability to produce more of its products, Tesla could cater to substantially more consumers in the near future. Don't forget, we've got the Gigafactory in Berlin, the Gigafactory in Texas, adding at least 500,000 units of actual capacity in 1 year. And considering China's recent results, concerns about domestic demand in the world's largest EV market might be overblown. A lot of people aren't really giving Tesla enough credit because of the Texas and the Berlin factories opening up, increasing their production capacity. And it's really tough to gauge this because I don't think anybody doubts that Tesla is an awesome company at this point. I don't think anybody doubts that Tesla's cars are great, Tesla's cars are high in demand. I think what people doubt is the valuation of Tesla, because even if you take every single one of their financial metrics and you cut them by half and you cut them by 50%, their PE, their PB, their PS, everything, you cut it by 50%, it still looks like an overvalued company. So how do we value Tesla? How do you engage with this stock? Do you just accept the overvalue is part of the package because it's an industry leader and you invest in it anyway, and you realize that just like whose line is it anyway, the words are made up and the points don't matter? I don't know. Like, what do you do here? So I think I'm bullish on Tesla going into the future, but it's like cautiously bullish because the valuation is still detached from reality, but the company is improving so much that eventually, like 20 years from now, the company's valuation is going to be worth it. But if the Jeffries analyst is correct and there's a gap growing between Tesla and the other OEM manufacturers, then it starts to justify the valuation a little bit more because that gap ends up turning into a moat at some point and then nobody can catch Tesla. Tesla has been soaring up, and most of this comes from the news where they were beating their expectations for their vehicle deliveries. That was the news that we got not last Friday, but the one before. And Tesla's been just almost a green arrow straight up, with the biggest gains coming on Friday. And this was after the Jeffries analyst increased the projection to $950 a share. We ended up closing at $843.03. After hours, $849. I mean, Tesla's flying. And with their vehicle delivery numbers being that much higher, I expect their earnings report, which is going to be coming out this week, to be just a blowout. In other news, we had all of the big bank stocks reporting last week. I love reading the bank earnings reports. It really gives you an idea of what's going on in the economy. B of A, Morgan Stanley, Wells Fargo reported better than expected third quarter earnings. Everybody reported, and the earnings were all really good. Some of the banks went up, some of the banks went down. I think the biggest mover was JP Morgan. I hope like nobody jumps in on JP Morgan after that rise, because all of the bank stocks are really slow movers, and I fully expect JP Morgan to come back down. The IV shot way up on JP Morgan this week after that earnings report. Take a look at some of the numbers. B of A earnings jumped to 85 cents a share on revenue of $22.8 billion. This beat the expectations of 70 cents and 21.68. Wells Fargo came in at $1.17 a share, beating the estimate of 96 cents a share. The revenue slipped off a little bit, about 0.6 billion. Morgan Stanley estimates were coming in about 169. They reported 1.98. Revenues beat almost by $1 billion. Citigroup was $1.80 a share expectations. The earnings came in at $2.15. Revenue came in a little bit higher than expectations. JP Morgan Chase was expected at $2.93. Theirs popped. I mean, this was a big beat, $3.74 a share. Revenue ended up rising a little bit. So all of the banks are showing a beat, and this kind of makes sense because the market's been really uncertain. People are probably starting to turn back to banks with their money. Once we eventually get into that area where the Fed starts increasing interest rates, you kind of want to be in banks at that point. But also, I found it very interesting. The revenue figures for a lot of the banks were including ACL figures. ACL figures are allowance for credit losses, and this is money that the banks set aside during good periods, and then they can bring it in to augment their balance sheet during not so good periods. And several of the banks, including Citibank, ended up pulling in the ACL money, and I found it really strange that they're allowed to report that ACL money as revenue. I guess it's deferred revenue in the past that they take in, and then they don't claim it so they can put it on their future revenue. This kind of makes their increases look a little artificial, and some of the stocks like Citi ended up dropping a bit. it. The reason is because they pulled in this ACL money and a lot of the more savvy investors picked up on that. That being said, out of all of the banks, I still feel that Citigroup is the best bet. Citigroup is the one that is trading the cheapest based on the PE, PB, PS ratios, and just looking at their market cap, their global influence overall. If I were to go in on a bank stock, and I haven't yet, it still would be Citigroup. And the reason that I haven't jumped in on Citigroup yet is because they've been trading in a channel. This is the channel that I'm talking about with Citigroup. Citigroup peaked out about $80 a share, and we ended up dropping as low as $64.88. But right now we're sitting kind of right dead in the middle of that channel at $72.29, and I'm not in any hurry to open up a position in Citigroup, even though the valuation is much more attractive than the other banks, because there's no real indication that we're going to be busting out of this channel. In fact, the channel is consolidating, but it looks like we still have a couple more weeks worth of consolidation before there's a breakout to the top or the bottom side, if TA is to be trusted. Here's Citibank's revenues, net income, EPS. Actually, I love this on their website. They make it so pleasant to look at this earnings report. Now, I don't know if it's because I actually bank with Citibank and this looks the same as their banking app, but when I saw this earnings report presentation on their website, I was like, oh, this feels so familiar. I'm at home. Now that I think about it, I think it's because it's the same iconography and the same style that they use on their app, so I feel kind of stupid now. But either way, this is much more pleasant to look at than a bullet point PR release just giving you a bunch of text with numbers in a line. They ended up repurchasing 43 million shares, which was nice, but you know, they have over 2 billion shares still floating around, so that's not really too helpful. For the next news story, do you guys remember when I talked about that Heartland Express, that tiny $1 billion market cap trucking company that was reporting its earnings? Well, I played an option on earnings and hallelujah, praise be to Jesus, I did not get killed on it. I feel like it's been so long since I was able to play an earnings option and not get absolutely wrecked on it. I ended up closing my position the day after earnings for a 23.7% gain or something like that in 1 week. I mean, less than a week, technically like 4 days worth of holding, a 23.7% gain. I tweeted about it. But anyway, I was so happy. You know, the company's earnings report was pretty mixed, but the positive side, the upshot, was exactly the stuff that I was talking about last week. They talked about making their fleet even younger. They talked about the truck driver shortage. They talked about the demand still being really, really high. They talked about their balance sheet being debt-free. They talked about their revenue, their EPS. It was a mixed bag there. I think they beat on the EPS and their revenue was slightly less than expectations. Whatever. It was a mixed bag, but it was actually generally positive, and it was a very forward-looking earnings report. I love that everything that I researched going into it was mentioned on the earnings report. Now, this is a couple of times that I've mentioned this on the channel, but I get like serious butterflies when I do all of this research into these options plays and I look at what the company's probably going to be saying based on industry trends, and then go to Motley Fool afterwards. I read their earnings report transcripts, and the CEO and the CFO say the same things I was expecting. Man, that makes me feel good as a researcher. And I was just happy that the stock behaved the way that I anticipated this time. But if you remember, I did buy the farthest outdated option, and that was because around earnings, it's kind of a crapshoot whether it goes up or down. And this one actually went up right afterwards and then down the next day. So I sold the next morning before the stock price dropped, got out of my position, scot-free, 23.7% gain, bada bing, bada boom. It's good to go. One small note about Heartland Express. This was actually their first earnings report in a year where they beat their estimates. They actually beat expectations, and it wasn't a really big beat, but 31 cents versus 30 cents estimated. Let's take a look at the upcoming earnings for the week. It is an exciting week. You guys know I'm a huge steel bull. Even with everything that's going on with China, we've got a lot of steel companies reporting, Steel Dynamics. We've got Nucor. Of course, we've got Cleveland Cliffs. I've got some Cleveland Cliffs news. You know, we've got American Airlines. We've got Kinder Morgan. I love Kinder Morgan as far as energy companies go. CSX, which is a train company. We got another airline, Southwest. I mean, there's just so many exciting things all over this earnings report. I don't even know where to focus. I feel like I'm being overstimulated here. You know, we've got Netflix, one of the FANG stocks reporting. Of course, Tesla, the big boy, Wednesday after close. AT&T's got a merger they're closing on. Maybe some news on that Thursday before open. This just looks fantastic. As far as earnings options plays, I'm not really going to call one out this week, and the reason for that is because I am going to be starting my entire options series, and I will tell you one thing I am going to be doing this week. I'm going to be selling 30 delta puts on Cliff, which is a bullish option play, not buying puts, selling 30 delta puts, and this is going to be part of my wheel that I'm going to be running on Cleveland Cliffs. Now, you might ask why I'm so bullish on Cleveland Cliffs, and if you're asking that, you probably haven't seen my videos for the last I'm not wearing a watch. 9 months, because I just love this company. They're going to be debt-free next year. And this week, they just made another acquisition that's going to help them process steel scrap. And this is kind of a big deal because scrap prices are incredibly high right now. And even though steel futures are kind of dropping off and there's an issue with the potential of the Chinese real estate bubble popping and China not importing steel, but America and Europe and the Western powers are still going to be using steel for building infrastructure if that bill ever does get passed. Either way, Cliffs is an incredibly financially healthy company, and I expect them, after they go debt-free next year, to start paying out a dividend because they're sitting on so much cash, and the CEO did say he wants to give back to investors at some point. This company is so exciting, but let's take a look at the acquisition they made this week. Cleveland Cliffs enters the scrap business and announces an acquisition. They entered a definitive agreement to acquire Ferrous Processing and Trade Company for a total enterprise value of $775 million on a cash-free, debt-free basis and subject to customary adjustment. Based in Detroit, FPT is among the largest processors and distributors of prime ferrous scrap in the United States, representing approximately 15% of the domestic merchant prime scrap market. They currently process approximately 3 million tons of scrap per year, approximately half of which is prime grade. This is a fantastic acquisition. You know, I've talked before about Cleveland Cliffs being a vertically integrated steel manufacturer, everything from iron ore mining all the way up to the finished product of the hot rolled steel. But now we're entering the scrap business, which is going to be kind of like, depending on how you actually define it, secondary or tertiary business. And this is going to allow Cleveland Cliffs to be more vertically oriented. I don't really know how to define that, but it is going to be a big step up for the company, and I'm so excited for it. And even though the price seemed a little bit steep and they did pay a premium on FPT, they are getting one of the largest scrap processors in America. I mean, it's not Schnitzer steel level, but it is in the Detroit area, which follows around the Great Lakes, which is where Cleveland Cliffs is located. So geographically, it's a good fit. Organizationally, it's a good fit. Steel is good. Steel is great. Let's go, Cleveland Cliffs. Okay, I'm a cheerleader. That's terrible. All right, let's back that one up a little bit. I want to undo that. I'm happy for Cleveland Cliffs, and I love investing in the company. Boom. There we go. That's it for me today. I hope you guys did enjoy the video. Like I said, please check out my short little option videos that I'll be releasing all week this week, leading into the big trading video next Friday. I hope you guys do enjoy the series. In the series, I'm going to be talking about how to employ a theta wheel strategy, and I'm going to be talking about how to avoid market correlations with a theta wheel strategy. This is going to be something that's kind of my own little twist on this, and the reason that I'm doing this is because I'm not super bullish on the stock market right now. So I'm going to be talking about a non-correlated theta wheel, which even if you already are familiar with the theta wheel, you're probably not familiar with the non-correlated theta wheel. And this is my own doing, and I'm excited about it, and I'm happy to share it with you guys. So anyway, that's it for me. If you enjoyed the video today and you want to support the channel, please check out my Webull referral link below the video. If you sign up for an account, deposit $100, you get a free stock, I get a free stock, everybody wins. Also, if you enjoyed the video today, please like the video, subscribe to the channel if you want to be alerted to all my content as soon as it goes live. Make sure you hit that notification bell. All right, everybody, thanks a lot. Stay safe. Good luck investing, and I'll see you next week.